Hi guys, in this video I'm going to be talking to you about the inverted yield curve, what it is and how it affects us as technical analysis traders in the stock markets. Let's get straight into it. Hi guys, it's Andy aka the Knock Trader, your friendly neighborhood swing trader, back again with another video. Remember to hit that like button, hit that subscribe button and hit that alert button to get alerts on all my latest videos. I've got Facebook, Twitter and Instagram at the Knock Trader on all social media platforms, and if you check that description section below you'll see a link to my mailing list. If you join my mailing list you get priority access to my free training course, and you also get weekly emails on my latest videos straight into your inbox. I've also got a Discord group called Pip Talks, and that Discord group is a chat room for like-minded traders and investors to talk about everything and anything to do with trading and investing. So click the link in the description section below for that chat room and join the community. Now, today I'm going to talk about the inverted yield curve. I want to talk about it because it was triggered again last week, and a lot of people are asking what does it mean and how does it affect the market. So I thought, let me give you an explanation of what it is and how it's relevant to me as a technical analysis trader and yourself if you trade technicals as well. I'm assuming you do if you subscribe to this channel. So I saw this article and it was talking about how the stock markets are affected by the inverted yield curve. But before I go into the inverted yield curve, I think you need a definition, and if I just give it off the top of my head, I'll probably butcher it. So I'm going to go to the trusted Investopedia. Now, an inverted yield curve is an interest rate environment in which long-term debt instruments have a lower yield than short-term debt instruments of the same credit quality. So I think that definition is a bit too wordy. The best way I'd describe an inverted yield curve is, so a bond, you have to know the definition of a bond to really know the definition of an inverted yield curve. So a bond is a kind of contract or note between yourself and as an individual and the government, your government or institution, where the same way us as individuals can borrow money from the bank to buy a house and pay interest on that money, so that they end up with more money than they lent you out. You can do the same to the government. So if you lend your money to the government as in the form of a bond for 10 years, you expect to get a higher interest back because you're lending it for a longer period of time. And if you lent it to them for 2 years, you'd get the money back, but you get a lower interest on the money that you paid and then the full amount back. So that's kind of the idea of it. The longer you lend the government your money, the more interest you can charge them on the money that you've lent them because you lent it for a long period of time. Now, if for some reason the stock market or just general economy is kind of in a downturn, what we find is that the yield of your long-term debt instrument, so they use the term debt instrument here, but what they mean is bonds. So if you lend for 10 years and then you lend for 2 years and you lend the same amount, if you're generating more yield on the 2-year bond than the 10-year bond, that is what they mean by an inversion of the yield curve. You're getting more yield from a short-term bond than you do from a long-term bond. I hope that's a good explanation. And whenever that's happened, over the last 7 times that has happened, we have seen a recession that has followed soon. When they say soon, it could be between 6 to 18 months, but we know that it's going to happen soon. We're like on a ticking time bomb the minute that happens. Now, the curve inverted around March 2019. The reason why it was around March 25th, 2019. The reason I tell you that happened then is because, actually, let me go into the charts. No, I'll go to the charts later. So around March 2019, March 25th of March 2019, the curves inverted, and then the market plummeted because people were scared. And this happened again recently. When I say recently, because you might be watching this at any time. This happened around, what's the date today? Around, I think it was the 8th of August 2019. So this happened again. Now, this article just talks about what an inverted yield curve is and how it's a precursor to a recession, kind of what I just said just now. So this kind of gives you the date of the last couple of inverted yield curves and when the recessions hit. So, but what I found interesting wasn't the article, but was one of the comments made by someone in the comment section, and this is exactly what encapsulates how I view these when the news reports on the inverted yield curve being triggered. So it says, sort of how fear works. People see the alarm, they panic and sell down the market, only to realize the stock market wasn't so bad. It rises, then comes the recession months later, and everyone panics for real. The market moves according to sentiment, far more than reality. That beautifully encapsulates what I think. So, when the inverted yield curve is triggered, at the end of the day, it is just an indicator. Nothing has actually happened to the market yet. But because people panic because of an omen to a recession coming, they get scared and they pull their money out of the market. So then the market tanks for a little bit, and then people realize, wait a minute, nothing's actually happened yet, and then they buy back. And when I see that market tank, I see that as an opportunity to buy the dip, because if nothing fundamentally has changed within the stock or the indice that you're trading, and it's tanked, then people are just selling on fear. But there's nothing founded on that. Fear is not founded on anything but just fear. So when they realized and come back to the senses, the market comes back up. But let me give you a prime example. I actually traded BAE Systems, which is a stock I traded around March. And around March was when the first indicator of this year, the first inverted yield indicator was triggered. So here's an article, March 25th. As you can see here, the US bond yield curve has inverted. Here's what it means. So that was March 25th. This is when the first announcement of 2019 about an inverted yield curve was basically announced. And that date is pivotal, because I'll show you why. So BAE Systems. I went long on a position on March 25th. So this is around March time. I took a long position on this stock, BAE System, and I think it was around here, maybe it was the 19th or 20th. I took a long position. The idea of that long position was I saw an ascending channel pattern forming. So the price had gone up, down, then down, and it kind of found the support here, and I thought it was going to carry on going up here. What happened is that at this point on the 25th, the inverted yield curve was announced, and then it plummeted. The share price plummeted, but then I held on to my position. The reason why I held on to my position was this plummet was based on fear of the inverted yield curve, but because, as I said, it wasn't. I saw it as just panic, market panic, that was founded on nothing. I just rode it out, and then it dropped in 3 days. It climbed back up to where it was within 3 days again. So the same time it took for it to drop almost 7%, which is 7%, 33 pips. Yeah, 7% drop in value. It climbed the same 7-8% in the next couple of days following. So that's just kind of just a visual aid to show you that. Not to say that if when the recession comes, things will plummet, and they will plummet fast. If we're not in the recession already, I'm not sure. But when you just hear news that scares you, you have to really evaluate. Is this news substantial news that can affect this stock, or is it something that can scare people into selling, but in reality, the price of the value of this stock or this index or whatever you're trading hasn't really lost anything? It's just retail or consumer sentiment it's just sentiment that's scaring people. You have to really just evaluate which of the two. If it's real substantiated news, so if like a company they lose all the boards, the head of the companies all get sacked, or there's like poison found in a food distributor, that's something that can actually affect the value of a stock. But if it's something that it's not really, that you feel like, now this is something that we could ride out, you have to just really understand that, and then maybe keep a hold of position or buy the dip, and then when it comes back up, you can make some profit. So I just thought I'd explain to you something about that, because this is the second time this year that this is the inverted yield curve has really affected the market, and I just wanted to give my 2 cents on how to trade this type of news. So anyway, it's Any, aka the Not Trader, signing out.